Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. In 2022, we witnessed a massive breakout in the inflation rate, the largest we've seen since the 1980s. So in this video, that is what we're going to be focusing on because this is going to have massive consequences for the financial markets looking forward. If you look at inflation between 1982 and 2020, we rarely saw inflation go above 4%, and we rarely saw inflation dip below 1%. Now you can see, of course, looking back in history, this type of period is exceptional. It's rare, and it is definitely not the norm. And so we're going to be focusing on that in this video. If you enjoy this video, don't forget to smash that like button. It really helps our videos get pushed out by the YouTube algorithm. So that is really appreciated. And of course, if you are new here, don't forget to click on that subscribe button. And now without further ado, let's get right into it. So let me put up the Dow Jones Industrial Average on top of this chart, make it a log scale chart. So we go all the way back to 1915. We compare the stock market, which is generally a good proxy for the economy, to what has happened to the inflation rate of consumer prices. So of course, again, since 1982, you've seen this very stable period of inflation, right? A lot of people think that the low inflation era started in 2009, but really when you look at this chart, it's very obvious that the low inflation era began in 1982, and it has triggered one of the largest secular bull markets in history. Now you can see we've had some comparable periods where inflation stayed pretty stable, and when I mean pretty stable, between around 0 and 4%. There's a handful of periods. It happened in the 1950s and 1960s, and it also happened between around 1934 and 1937. Right here, inflation was pretty stable throughout this period. Now, in all of these cases, you saw the stock market absolutely boom. The 1920s, right before the Great Depression, the 1930s, the 1950s, and of course, between 1982 and 2020. But as we discussed at the beginning of the video, this is definitely not what happens the majority of the time. The majority of the time, inflation is a problem, whether that's to the upside or to the downside. That's called deflation. So you can see here in 2022, we broke out of this range that we were staying in since 1982, and this is going to have some massive consequences, and I'm going to show you exactly why in this video. The fact that inflation has broken out destabilizes the entire system that we've had in place since 1982. Let me put the federal funds rate on top of this chart. Throughout this entire period, we've seen the Federal Reserve, so the central bank that really dictates how easy it is for people to borrow. They've been able to focus on the strengthening of the economy by stimulating the economy more and more. The Fed has a dual mandate. They have the stable prices mandate, that's inflation, and they have the employment mandate. Now, of course, since 1982, prices have been pretty stable. So their biggest concern throughout this period was keeping the unemployment rate as low as possible by being stimulative and very accommodating for the economy and for the markets. So why is this breakout such a big deal? In any case, most economists agree that inflation has peaked. It's coming back down very violently, and we're likely to see inflation at around 2% throughout 2023. And again, looking forward, that this is just going to be this one-off spike, and we're going to be coming back to the 2% target. Today, with the inflation breakout that we saw in 2022, even though that could create some optimism in the stock market over the next few months, the odds that inflation is just going to come back down straight to 2% and stay there are extremely low. The odds that this is just a one-off spike and that we're going to be coming back to this era of low inflation is very low. Now, the reason for that is because the Federal Reserve uses its interest rate to modulate inflation. And since 1982, considering the fact that inflation has not been a problem, they've been able to stimulate the economy more and more, to lower the interest rate, to give a boost to the economy when there is a recession. But when inflation comes back into the picture, all of a sudden, their job becomes 100 times more complicated. They can raise rates too much, and create a big recession, a hard landing, or they can raise rates too little like they did in the 1960s and 1970s, where inflation eventually becomes entrenched, it trends higher and higher, and interest rates trend higher and higher. So whether we have this type of period where inflation really begins to trend higher and higher, like in the 1970s, or we enter this type of period, like between 1916 and 1948, where inflation had wild swings up and down as monetary policy was too loose, inflation skyrocketed, or the Fed tightened too much, created a deep recession, triggering a period of deflation, a depression, like the 1930s as well. In either case, let's see what the stock market performance looks like in this type of environment. You can see here, this was an extremely difficult period to navigate as an investor, and the 1970s, of course, a very difficult period to navigate. Inflation breaking out is a massive deal. It destabilizes the environment that we've had since 1982. Think about how long of a period that is, where investors have gotten used to low inflation, have gotten used to Federal Reserve that is stimulating the economy, and where the risks of over-tightening or under-tightening are low. If we really are coming out of this environment, there are some major risks ahead for investors. Now, of course, in the near term, there is a big play to make, and I'm going to put vertical lines here every time we've seen inflation, as we did here in 2022, inflation coming back down. A lot of these peaks in inflation have coincided with major market bottoms. And so that is how we're currently positioned with the model portfolio at gameoftrades.net. And you can see, in fact, since inflation has peaked, the stock market has seen a tailwind and has behaved quite nicely here. Now, the greed that is in the financial system and that has been in the financial system throughout the past 40 years is not going to go away overnight. Investors today are looking for the first reason for the market to go up. Passive investing, long-only hedge funds, the growth of derivatives, the competition, the sheer competition there is for hedge funds and financial institutions to post high returns as the markets have gone up non-stop in this low rate, easy money environment. That's not going to go away overnight. And so disinflation, inflation coming back down over the next few months, we think that's the final leg up of this bull run. Now, of course, all of our convictions, all of our entries or exits are highlighted in our model portfolio. We walk you through all of our key trades right now. We show you our thought process by posting quick macro articles and lightning reports giving you a quick overview of everything that's going on in the market. If you're interested in this kind of service, make sure to click the link down below and grab yourself a free trial. You can test out the service, no questions asked, and see if this is something that you'd find helpful in your investment journey. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to click on that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.